Alright, so let's talk about a stock that's been on an absolutely wild roller coaster lately, and that is Opendoor, ticker symbol OPEN. This company has become the poster child for market volatility, with some analysts saying it could rocket to over $80 a share, while others like Goldman Sachs are slapping it with a price target of less than $1. How is it possible for one single stock to have such a massive, almost unbelievable range of outcomes? Well, that's exactly what we're going to break down today, because what's happening with Opendoor is a fascinating case study in market mechanics, retail investor power, and the classic short squeeze setup. You see, what started as a struggling real estate tech company has now found itself at the epicenter of a meme stock frenzy. We're talking about a 90% price surge in just a few days, trading volume going through the roof, and options activity hitting all-time highs. It has all the ingredients of the meme stock mania we saw back in 2021, and for anyone watching the markets, this is a situation you just can't ignore. It's a high-stakes game where fortunes could be made or lost almost overnight. So in this video, we're going to get into the nitty-gritty of it all. We'll look at the massive short interest, the factors that could push this stock into a full-blown squeeze, and what could send it crashing back down to earth. We'll break down the bull case, the bear case, and give a realistic outlook on where the price could actually go from here. Whether you're thinking about trading it, or you're just fascinated by these market phenomenons, stick around, because you're going to want to see this. And as always, make sure to smash the like button for the YouTube algorithm if you get any value out of this. It costs you nothing, and it really helps the channel out. So, to really understand what's going on with Opendoor, we have to start with the short interest. For those of you who aren't familiar, short selling is when investors bet against a stock, hoping its price will go down. They borrow shares, sell them, and plan to buy them back later at a lower price to make a profit. Right now, Opendoor has a massive short float of around 21.6%. To put that in perspective, anything over 20% is considered extremely high and signals that a huge portion of the market is betting heavily against the company. This creates a very tense situation. It's like a coiled spring, just waiting for the right catalyst to pop. Now, when a heavily shorted stock starts to go up instead of down, those short sellers start losing money, and fast. To stop the bleeding, they're forced to buy back the shares they borrowed to close out their positions. This buying pressure from the shorts, combined with buying from regular investors, can create a rapid, explosive price spike. This is what we call a short squeeze. It's a feedback loop where rising prices force more shorts to buy, which pushes the price even higher, and so on. This is the exact dynamic that sent stocks like GameStop and AMC to the moon, and with over 1/5 of its float sold short, Opendoor is sitting on a similar powder keg. However, there's another critical metric we need to look at called days to cover. This tells us how many days it would take for all the short sellers to buy back their shares based on the stock's average daily trading volume. For Opendoor, the days to cover is surprisingly low, at around 1.5 days. This means that, despite the high number of shorted shares, the trading volume is so massive that the shorts could theoretically cover their positions in just a day and a half. This is a double-edged sword. While the high short interest creates the potential for a squeeze, the low days to cover might act as a safety valve, potentially limiting how explosive and sustained that squeeze could ultimately be. Now let's talk about the recent price action, because it has been absolutely insane. Just recently, Opendoor's stock price surged by over 90% in a matter of days. This wasn't a slow, gradual climb based on some positive company news. This was a vertical takeoff, fueled by pure, unadulterated speculative frenzy. The trading volume went completely parabolic, shattering previous records. We're talking about hundreds of millions of shares changing hands daily, which for a stock like this is an astronomical amount. It shows that an army of retail traders had descended upon Opendoor, all trying to pile in at the same time. On top of the share volume, the activity in the options market was off the charts. The number of call options being bought hit an all-time record. A call option, remember, is a bet that the stock's price will go up by a certain date. When you see a massive spike in call buying like this, it's a telltale sign of retail-driven speculation. Traders aren't just buying the stock, they're making highly leveraged bets that it's going to continue its meteoric rise. This creates what's known as a gamma squeeze, where market makers who sold those call options are forced to buy the underlying stock to hedge their positions. adding even more fuel to the fire. This entire pattern of behavior, the rapid price surge on no news, the astronomical volume, and the record-breaking call option activity, is classic meme stock short squeeze 101. It's the exact same playbook we saw with GameStop, AMC, and BlackBerry back in the day. Social media platforms like Reddit's Wall Street Bets and StockTwits were buzzing with posts about Opendoor's short interest and squeeze potential. It became a self-fulfilling prophecy where the chatter drove the buying, and the buying validated the chatter. This wasn't about fundamentals anymore, it was about momentum, hype, and the collective will of a massive group of online traders. So, the million-dollar question, or in this case, the $80 question is, how high could Opendoor actually go? This is where things get really interesting because the opinions from Wall Street are about as far apart as you can possibly get. On one end of the spectrum you have the Super Bull case championed by people like investor Eric Jackson. He's made the argument that if Opendoor can just survive the current housing market downturn and prove its business model, it could eventually be valued at something like $80 per share. This is a long-term vision based on the company revolutionizing the real estate market. This bull case hinges on the idea that Opendoor's iBuying model, where they make instant cash offers on homes, will eventually become a dominant force in real estate transactions. If they can capture even a small fraction of the multi-trillion-dollar US housing market and achieve profitability, the upside potential is, theoretically, enormous. It's a high-risk, high-reward bet on industry disruption. The bulls are looking past the current losses and high interest rates, and they're seeing a future tech giant in the making. They believe the current stock price is a massive discount on that long-term potential. But then, you have to look at the other side of the coin, which is the brutal bear case. And it doesn't get much more bearish than Goldman Sachs, who have a price target of just 90 cents on the stock. Their argument is based on the here and now. The company is burning through cash, the housing market is struggling with high mortgage rates, and Opendoor's core business model is facing immense pressure. The bears see a company with flawed fundamentals that is unlikely to survive in its current form, especially if the real estate market remains weak. This incredible divergence from $80 to 90 cents perfectly illustrates the speculative nature of this stock. It's a battle between a long-term dream and a harsh, short-term reality. When you're dealing with a stock as volatile as Opendoor, you have to watch a few key factors that can move the price dramatically. The first, and maybe the most important in the short term, is retail momentum and social media chatter. This stock is currently living and breathing based on hype. You need to keep an eye on platforms like Wall Street Bets, StockTwits, and X, formerly known as Twitter. A surge in mentions, a new DD or due diligence post that goes viral, or a trending hashtag can be the spark that ignites another wave of buying. The sentiment of the retail crowd is the engine of this trade. The second factor is options expiration. Major monthly and weekly options expiration dates are huge events for meme stocks. On these days, a large number of options contracts expire, forcing traders and market makers to settle their positions. If the stock price is near a major strike price where a lot of options contracts are clustered, it can lead to intense volatility. This is where you see those Max Pain theories play out, and the battle between the bulls and bears becomes a tug-of-war that can swing the price wildly in the final hours of trading. These dates are marked on every trader's calendar for a reason. Third, you have to be aware of the broader meme trade chaos. Opendoor isn't trading in a vacuum. Its fate is often tied to the sentiment around other meme stocks like GameStop and AMC. If those stocks start running, it often creates a halo effect that lifts other high short interest names along with them. It's a risk-on environment where traders are looking for the next big squeeze. Conversely, if the meme stock rally fizzles out, it can drag Opendoor down with it, regardless of its own specific situation. And finally, don't forget the actual company fundamentals. News about their cash burn, inventory levels, and especially the upcoming reverse stock split are critical. A reverse split is often seen as a negative sign, and its execution could completely change the trading dynamics. Okay, so let's cut through the noise of the $80 dream and the 90-cent nightmare and talk about some more realistic price outlooks based on different scenarios. First, let's consider a pure short-term short squeeze. Given the high short interest but relatively low days to cover, a realistic target for a quick, momentum-fueled squeeze would likely be in the $3 to $5 range. This would represent a significant pop from its recent lows, enough to inflict some serious pain on short sellers and reward momentum traders, but it might not have the legs for a multi-week parabolic run unless something fundamentally changes. Now what if this isn't just a one-off squeeze but the start of an extended meme cycle, similar to what we saw in 2021? If retail momentum holds strong, the social media hype continues to build, and we see a sustained gamma squeeze from options activity, then you could start looking at a much higher range. In this scenario, a move into the $10 to $20+ range isn't out of the question. This would require a perfect storm of factors, including a broader market rally in speculative assets. This is the scenario the diamond-handed bulls are hoping for, a true trip to the moon that goes far beyond just a simple short squeeze. Then there's the fundamental reversal case. This is less about a squeeze and more about the company itself turning a corner. If Opendoor can show in its next earnings report that it's managing its inventory better, slowing its cash burn, or benefiting from a stabilizing housing market, the stock could see a sustained rally based on improved investor confidence. This would be a slower, more fundamentally driven climb, likely into the $5 to $10 range. And finally, we have to respect the bear case. If momentum dies, the reverse split spooks investors and the housing market worsens, the floor set by analysts at that 90-cent to $1 level becomes a very real and painful possibility. So given all this volatility and the wide range of outcomes, how should you even think about approaching a stock like Opendoor? The first thing to understand is that this is not a traditional, long-term buy-and-hold investment, at least not right now. This is a speculative, tactical play. The strategy here is primarily momentum trading. This means you are trading based on the price action and the flow of money into the stock, not on the company's long-term financial health. You are trying to ride the wave of hype, get your profit, and get out before the wave crashes. With that in mind, risk control is absolutely paramount. This cannot be overstated. When a stock can swing 20 to 30% in a single day, you have to protect your downside. This means using stop losses. A stop loss is an order you place to automatically sell your shares if the price drops to a certain level. It's your emergency exit. Decide before you even enter the trade how much you are willing to lose, set your stop loss accordingly, and stick to it. Don't let a small loss turn into a catastrophic one by hoping the price will bounce back. Hope is not a strategy, especially not in a trade like this. Ultimately, you need to treat this as a high-risk, speculative bet. Only trade with money that you are fully prepared to lose. Because of the extreme volatility, it's also wise to consider trading with smaller position sizes than you normally would. This isn't the kind of stock where you bet the farm. It's a calculated risk in a very chaotic environment. The goal is to catch a piece of the upward momentum while rigorously protecting yourself from the very real possibility of a sharp and sudden downturn. This is a trader's market, not a set-it-and-forget-it investment. So there you have it, a complete breakdown of the absolute chaos surrounding Opendoor. It's a fascinating mix of high short interest, meme stock mania, and a fundamental business story with a hugely uncertain future. The potential for a squeeze is very real, but so are the risks of a massive drop. This is the kind of setup that can create incredible opportunities for traders who are prepared, but it can also be a minefield for those who jump in without a plan. The key is to stay informed and watch the signals closely as they develop. For those of you who want to track these signals in real time, there are some fantastic platforms out there that can give you an edge. You can monitor social media sentiment and short interest data using sites like Swaggy Stocks and Quiver Quant. You can keep your finger on the pulse of retail trader conversations on StockTwits, and you can find stocks with unusual trading volume, which is often a precursor to a big move, by using screeners on sites like FinViz. These tools are essential for seeing what the rest of the market is looking at and for spotting momentum shifts as they happen. Navigating this kind of volatility requires having the right information at your fingertips. If you're interested in taking it a step further and want help setting up a live dashboard to track these key metrics, or even a custom alert system that notifies you of critical changes in volume, sentiment, or options activity, feel free to reach out. I can help you build a setup tailored to your trading style. Thank you so much for watching. Don't forget to hit that like button. Subscribe for more breakdowns like this, and I'll see you in the next video.